Well, this is third quarter earnings with Bloomberg Quint and Capital First. Strong quarter, profits and net interest income both have seen a substantial jump. Joining us to talk about the quarter gone by and the outlook ahead is Mr. Vaidyanathan, CMD at Capital First. Mr. Vaidyanathan, thank you so much for taking the time out and joining us.
Thank you.
It's been across parameters, I would say, it's been a strong quarter. Would it partially be aided by the fact that there was a low base the last quarter? And part two of my question would be, if this is what you've done in the O&D quarter, is this a sign of things to come for the next few quarters as well until the merger happens?
It's not really on a lower base or higher base, actually. If you take a CAGR of Capital First of 5 years at a stretch, it is a CAGR growth top line of 27% of AUM and profit growth of 40%. So I think it's been a steady story coming from in the last 5 years. In our case, frankly, it's a pretty straight business. You know, you grow the loan book, you get the more NII. As long as the quality is good and credit losses are under control, the profit continues to grow. And that's what's happening at Capital First.
Yeah, but if the reason why I ask this, because across all parameters, both the AUM growth as well as the profitability, the numbers, good as they are better than what the best of the estimates were on the street. So did a base factor also help you, or is this pure business momentum that could last into the quarters ahead, is my question.
Very good question, actually. See, we always guide for 25% growth for the last many years. It's 30% this year. So I think definitely for this year, ending into March, we are expected to close at 27,000 crores, which would be anywhere about 30 to 35% over a starting base of 20,000 crores of last financial year. So I say this year looks pretty much safe and in the bag. For the next year, probably we'll guide for 25% again.
Okay.
It's too early, I know, to ask you about, if you've started thinking deeper with respect to the strategy for the bank, and we just spoke about 10 days back, but just wanted one clarification. Post the merger, the share of Warburg Pincus will go slightly above 10%, if I'm correct, and if that's the case, they'll have to bring it down, just below that 10% mark. So have you heard from them on what their strategy is with respect to their investment in Capital First?
That's correct, actually. About 10.2 or 10.3% would be their share. On the other hand, IDFC is holding an IDFC Bank, so I would actually be a little short of 40%, probably close to 37%. So they will anyway need to buy, because I don't think they're applying for a dispensation from what I hear from them. So I think one has to sell and one has to buy, and I think there is still probably be a shortfall for IDFC in the whole equation. So that's how the equation will play out.
Okay, then we'll talk about Capital First, third quarter numbers only then. Okay, the third quarter numbers definitely increase some confidence that GST on SME and MSME, the impact has definitely diminished. So just wanted to understand if you believe there are absolutely no concerns on asset quality and gross NPAs, you think going into the next few quarters at least will remain between the 1.5% to 2% band itself?
You're absolutely right. Actually, when the GST when the demonetization happened in November of 2016, in the next quarter, we saw the gross NPA and net NPA for Capital First slightly going up by 20 basis points. It had moved up from 1.53% to 1.73%. Over the last 4 quarters after demon, it's come back to where it began. So basically, we can safely say that the impact that happened in the marketplace is fully neutralized, both on the gross front and the net front. Now, our reading from the market and by talking to entrepreneurs is that broadly things have settled, and therefore we don't expect any negative movement in our NPA numbers from here on.
So, okay, I have a two-part question to this. One is, if I look at how your margins have done, they've done remarkably well. And your high-yielding loans, if I'm not wrong, continue to rise, both two-wheelers, consumer durables. Is this setting the base for an already impressive set of margin numbers to expand meaningfully over the course of the next 12 to 18 odd months?
We don't guide for any further increase of margins from here. The reason being that you can see that the bond yields have also been inching up, so it won't be very appropriate to guide for any improvement from here. But I'd say that we are quite comfortable to say that the NIMs will be maintained for sure. There's an upward bias to the NIM, if anything, but certainly there is no downside risk to it. We don't see it.
Okay, so I have one more question. I mean, I think there's a classic debate, though. managements have by and large said that there is an increase in the cost of funds. I think the debate that came about was that when you look at the yield curves, the long end of the yield curve has certainly moved up, not so much for the short end, and therefore the increase in cost of funds for NBFCs by and large will not be as steep as maybe the market is pricing it to be. How would you think of this over the course of the next 12 to 18 months? Again?
I will tell you our practical numbers if that helps you understand this equation better.
Yes.
Actually, typically what has happened is that in the last 3 months, I think the bond yields have hardened by anywhere between about 60 basis points or so. But what's happened is that the margin at which you borrow above the G-Sector actually has come down. So therefore, the increase in 60 to 70 basis points of yield from say 660 to 7.3 has not directly got translated to the borrowing cost.
Okay.
So that's one important factor to note. The second factor to note is that the bonds are not the only source of borrowing. It's a significant part of the borrowing, and it only affects incremental borrowing. The whole stock in our case are 20,000 crores. That's not getting repriced. These are fixed bonds. So the blended impact of this bond increases could be about say 10 basis points or so. And for our business sorts, 10 basis points is neither here nor there. So I actually take pains to clarify to people that nobody should worry about bond yields going. It's not the cost of funds gone by 60 basis points. It's only incremental. And it's a lender's business. For lender's business, sometimes costs will go up, sometimes they'll come down. It's our job to keep aligning our lending rates.
Sure. Yesterday, of course, government announced, when they announced the recap plan for banks, they've also asked them to push lending towards SMEs. And of course, PSU banks have that capital to lend now, which they didn't so far. So is this a risk to SME-focused NBFCs like yours? There'll definitely be some, if not market share loss, but there's definitely going to be some tougher competition as far as maintaining market share is concerned.
Well, I can say this quite sincerely, actually, not just for your channels, that that the arrival of more state-owned banks and more players in the small and medium enterprise segment is actually great for India and great for all players. Because you really never want to be the big player in town and nobody else being there. Because if the state-owned banks were not lending to the state-owned to that small and medium enterprise sector, now it would be pretty difficult, so to say, for existing players to even refinance a particular loan, for example. You don't want to be the only lender to a customer. So actually more players coming in, the market expands. We really are looking forward to it. Actually, when the news came, not just yesterday, the first time they announced the 2.11 lakh, there was a yippee kind of a feeling, fine, that, they're back in the market and stuff. So actually it's good for India, I can tell you.
Good for India, but will it only increase the competitive intensity? Because so far they were not.
No, you're making a good point.
Lending.
You're making a good point. I'm happy you're asking this. I'm saying when the pie grows, it is really good for existing players and particularly good for nimble players. So, for example, the US economy over the last maybe 30 years, as if there's moved from, say, being a 10 trillion economy to a 16 trillion economy, every player there has benefited. So I would say, therefore, that if the pie grows, it is really good. If you see the extent of SME lending in the sector, it's not more than 16% of the banking system's credit. It's really low. At some stage, it has to grow up.
Actually, so coming on that, Mr. Vaidyanathan, do you reckon that PSU banks, which are arguably not as nimble as NBFCs in this pocket, NBFCs like you, Bajaj Finance and the others, they're not as nimble. Do you think now with this push stroke capital availability to actually do that piece in the MSME space, they'll be able to actually create the market that they hitherto have vacated in large portions?
It depends a lot on the skill set, actually, more than the availability of funds. But certainly, this gives them more muscle. It gives them more ability to be more active in the space. And certainly being crippled with capital does not give them the feeling that they want to lend. I think just the tonality will change.
Sure.
I am almost seeing every chairman or every managing director of every large bank, state-owned bank, now talking that we want to grow SME. Sure. And that's uniformly 10 on 10 talk this language. So I think that's really good news. And by the way, let me not say that all state-owned banks, let us not say that all state-owned banks are not nimble. For example, look at State Bank of India.
No, of course. I mean, they haven't vacated market share at all.
They're a league of their own. So
completely agree. Okay, I have answered my questions on all capital first quarters. If you have any, because I just wanted to ask a budget question as well, unless you have a capital first question. What do you expect this year's budget, both from a perspective of a retail-focused NBFC, as also from a perspective of a soon-to-be bank?
Well, actually, I say it's not just a expectation. Actually, I would put it as a wish that we make serious investments in agriculture, because I think that is one area that people are really worried about, and you can see the storylines coming there. Of late, I think that story is also improving because of 2 good monsoons and maybe some consumption push through Narega and all that. But fact is that is one big story. Second big story I'm really looking forward is infrastructure. Really, for the financial sector, it's nothing, there is no really demand list, wish list, nothing like that. I'd say if it's a pro-poor, pro-agriculture, pro-infrastructure budget, I'll be very happy. And that's what I actually expect. The election year coming up, I'd certainly expect that much.
Well, let's hope fiscal prudence also stays a part of it. But yeah, I think the point is well taken. Mr. Vaidyanathan, thank you so much for taking the time out and joining us
thank you very much.
on this third quarter interactions. Well, this was Capital First in a strong quarter from Quest.